All right, let's talk about a corner of the market that gets a ton of buzz, penny stocks. You've heard the stories, right? Someone throws a few bucks at a tiny stock, and bam, it turns into a small fortune. But is it really that simple? Let's dig in. This is the dream, isn't it? The idea that you can get these massive returns from these tiny little stocks. It's super alluring. But before we get too carried away with the hype, we really need to get on the same page about what a penny stock actually is. So the official definition comes from the SEC. That's the Securities and Exchange Commission. They say a penny stock is a security from a pretty small company, one with a market cap under $250 million. And even though the name has penny in it, the widely accepted rule of thumb is that we're talking about any stock trading for less than $5 a share. You know, maybe the easiest way to wrap your head around penny stocks is to think of them as the total opposite of what we call blue chip stocks. I mean, think about those huge, stable, household name companies. Penny stocks, they're on the other end of the spectrum. We're talking high risk, low price, and often these companies have barely any financial track record to speak of. Okay, so if these aren't the big name companies you see on the news every night, where in the world do you even find them? Well, they tend to hang out in a different part of the market, away from the major exchanges. Let's look at why that is. The big leagues, like the New York Stock Exchange or the NASDAQ, they have rules. They have standards. For example, NASDAQ has what they call the $1 rule. If a stock's price dips below $1 for too long, it gets kicked off the exchange. So, since most penny stocks can't meet that bar, they trade on what are called over-the-counter, or OTC markets. These places just don't have those same strict price requirements. All right, so we know what they are and where they live, but with literally thousands of them out there, how do you even begin to find one to trade? Well, this is where having the right toolkit is absolutely key. One of the best tools for the job is a stock screener. It's basically a search engine for stocks. You can go in and set all kinds of filters to narrow down the universe. So you could start with step 1, pick a screener. Then step 2, tell it, hey, only show me stocks under $1, and maybe narrow it down more by saying, and only in the drug manufacturing sector. It's a really simple way to find a needle in a haystack. And poof, here's what that can look like. You run your search for drug companies under $1 and you get this nice clean list. You see the ticker symbol, the company name, the price. It gives you a solid starting point to begin your real research. Okay, let's say you've done your homework and you've found a stock that looks promising. Great. Now what? You actually need a way to buy it. And that means you have to pick a brokerage account. And believe me, when it comes to penny stocks, this choice is really, really important. Here's why it's so important. The fees. You see, some brokers charge you on a per-share basis. Now, think about it. With stocks this cheap, you might be buying thousands of shares at a time. Those per-share fees can add up like crazy and just eat away your profits. That's why a lot of traders in this space look for a broker with a flat rate fee. You know, one single commission for the trade, no matter how many shares you're buying. It's often way more cost-effective. All right, we've gone through the what, the where, and the how. But we absolutely cannot go any further without talking about the risks. And I'm not kidding here. With penny stocks, the dangers are very real, and you have to go in with your eyes wide open. This quote right here, this gets to the heart of probably the single biggest danger. It's called liquidity, or more accurately, the lack of it. Liquidity just means how easy it is to sell something. And with many penny stocks, when you want to sell, there just might not be anybody there to buy. And that means you can get stuck, literally stuck, holding on to shares while the price just falls off a cliff. And getting stuck is just one of the problems. These stocks are also famous for price manipulation, you know, the classic pump and dump. That's where a group of people hypes up a stock to drive the price up. Then they sell all their shares at the top, leaving everyone else holding the bag. On top of that, you're not going to find big investment funds playing in this space. And a lot of the time, the companies themselves are in really bad financial shape, sometimes even close to going bankrupt. These are serious, fundamental risks. So that brings us right to the end, to the one question that you have to ask yourself. You've seen the potential for massive gains, but you've also seen the very real, very serious risks. So the question is, for you personally, does that potential reward outweigh the undeniable risk? And that is a question that only you can answer.